Good day to everybody. I am Nicolas Bornozis of Capital Link, and I would like to welcome you to Capital Link's Trending News podcast series. We are delighted to have with us today Mr. Hamish Norton, the president of Nasdaq-listed Star Bulk Carriers. Hamish is going to discuss with me the company's recent earnings, the second quarter 2024 earnings, as well as the company's strategy and the sector outlook. Very quickly, in terms of the usual disclaimer, our podcast is purely for informational and educational purposes, does not constitute investment advice or advice of any kind. And as further disclosure, Capital Link has the privilege to work with Star Bulk on investor relations. And with this, I am going to welcome Hamish, and I will ask him the first question. We are going to start with the very strong earnings, that performance that you had for the second quarter of 2024, with net income of 106 million and a TC per vessel of 19,268. Now, what are the key factors that contributed to the strong performance, particularly in comparison to the second quarter of last year?
No, thanks, Nicolas. So first of all, the net income is aided by the fact that we're a much larger company than we were last year. On April 9th, at the beginning of the second quarter, we closed a merger with Eagle Bulk Shipping, and that added about 55 ships to our fleet. So that was a contributor to the higher net income. We also have lower debt than we had a year ago. We've been paying down about $200 million of debt per year. And so, the interest expense was less than it might otherwise have been. And then, we have a pretty strong market. First of all, demand for dry bulk movements is very strong. I think some people have been worried about the weakness of the Chinese economy, but China has nevertheless been importing a very large amount of iron ore, a very large amount of coal, and a large amount of grain. So, their effect on the dry bulk market has been very positive. And then unfortunately, the Panama Canal has been somewhat restricted in capacity due to lack of rainfall, and the Suez Canal has been restricted due to basically attacks on shipping in the Red Sea. And the closure of those two major canals has caused ships to take longer routes and has strengthened the market significantly. And then, of course, our entire fleet virtually has scrubbers. And one of the reasons that Eagle was such a good fit with Star was that Eagle's fleet was essentially entirely scrubber fitted as well. And the scrubbers add a few $1,000s a day to our results. So it's quite significant.
Thank you. Now I will go to the dividend payout and to the capital allocation. You declared the dividend of 70 cents per share for the 14th consecutive quarter, and as you pointed out in the press release, since June of 2021, you have paid out in dividends $1.25 billion. So can you share more about your approach to balancing shareholder returns with reinvestment in the business, particularly in light of your recent merger with Eagle Bulk?
Yeah. So we adopted dividend policy in 2019 to pay basically all of our operating cash flow after debt service. And that includes interest, but also amortization of our debt. And And basically all of our debt amortizes. We did inherit a convertible bond from Eagle, which did not amortize, but that bond converted just prior to maturity and is no longer outstanding. It turned into common shares. And so basically now all of our debt amortizes, and that's at the rate of about $200 million a year. So we're paying down $200 million a year of debt. And as a result, we are in effect reinvesting that money in the business. And operating cash flow in excess of that, we pay out as a dividend as long as we've got 2.1 million of cash on the balance sheet per ship. That is the requirement that our board has set out. And we think at a time when it does not look to us like the best use of our cash to be buying new ships, that this is probably the best thing we can do for our shareholders. And we think that's a prudent balance.
Absolutely. I mean, I had a question about liquidity, but I think you already alluded to that. Right now, you have over 500 million in total liquidity, but that is before paying the dividend, and you have net debt of approximately 860 million. So I think you gave us the formula of how your liquidity is evolving, and maybe you can add some more comments.
Sure. Well, look, I think over time our liquidity is likely to go up because we do have the 2.1 million per ship that our board requires to exist on our balance sheet before we can pay a dividend. But we have been selling ships in this relatively strong sale and purchase market that we know that we will have to replace. These tend to be the older and less fuel efficient ships for which we are getting very good prices in the market. And the cash we generate through sales of vessels is not, we do not pay that out as a dividend. We've been keeping that on our balance sheet. And we will use it at some point either for buying new ships, paying down debt, or possibly buying back shares.
Thank you. And now I will move on to the next topic, the integration effort with the Eagle Bulk. This is the first quarter that you are reporting as a combined entity. How is the overall integration process progressing?
I think it's going pretty well. This is the first real operating company, with a sophisticated, set of processes that we have acquired. We did 8 M&A transactions in the recent past, using our shares at NAV or higher to buy fleets. But this is a real company. Eagle has a bunch of talented people, a bunch of complex business processes, and frankly, a very sophisticated chartering operation, which we really want to preserve and basically make sure it flourishes. And we know that this is not something we're expert at. And so we're going very slowly and cautiously, and we don't want to break anything. And we're not. I think it's working well. And we basically want the people who come to Star from Eagle to take over the management of our existing fleet of Supramaxes and Ultramaxes. And they have a history of being able to get very good revenue per ship figures for Supramaxes and Ultramaxes. And we have a history of operating ships at very low cost. And if we can get their revenues on the whole fleet of supers and ultras and our costs on the whole fleet of supers and ultras, that's going to be a very, very good combination. And that's what we're aiming for, and that's what I think we're achieving.
That's great. And now that the related question to that is, you talked about your planned cost and revenue synergy target of about 50 million. Can you provide some more details on the specific areas where these synergies, especially on the cost side, are expected to come, and how confident are you in meeting these targets within the planned timeline?
Well, I think what we told people when we proposed the merger was that we believed we could get 50 million of synergies in 18 months. And I think we're definitely on at least that schedule. We have found a bunch of areas where we can cut costs. So, for example, we have already refinanced the debt at Eagle, and we are saving quite a bit of money in reduced interest costs on that debt. We have already redone the insurance at Eagle, and we have saved a bunch of money on the insurance. We believe we can save very significant money on dry docking. And that's coming through very quickly. We have not yet gotten all of the savings that we expect to get on operating cost per vessel per day, but we expect to basically get the operating cost of the Eagle fleet down to very close to the level of operating cost of the former Star fleet, meeting the synergy target of 50 million, we think will be, will meet or beat that. And we believe we'll be getting some revenue synergies over time, as well as some savings on overhead, because there are inevitably some duplicative positions, that we'll save some money on.
Now, let me move on to a topic that you already touched upon, vessel sale and fleet management. You recently completed or agreed to the sale of several vessels, generating proceedings and gains. How does this align with your broader strategy for fleet management and optimization, which I understand are among the distinct competitive advantages of Star Bulk, particularly in the context of the current dry bulk market? I mean, fleet renewal, fleet optimization, and so on.
Yeah. So the answer is we are selling a number of older and less fuel efficient ships, taking advantage of what we think is a good time to start the process of fleet renewal, in a strong market. But that does not impact our view that managing ships well is a strategic talent of Star Bulk. We think it's very important to manage our ships. It gives us a lot more control over our destiny. And for example, when in 2019 we made the decision to equip our entire fleet with scrubbers, we got 100 scrubbers installed in under a year, and it couldn't have happened if we had not been in charge of our own technical management. And we think we do a good job of technically managing ships. Now, the fact is that even though we're selling ships, we are managing more and more ships every day, because taking over management of some of these ships is it's very challenging. Eagle did technical management, but farmed out their crew management. We are taking crew management back over, but it's a slow process. We have to recruit crews, and it's going to take time. It's going to take time, and that's one of the factors that's going into the 18 months to achieve full synergies.
So now let me go forward and talk about future growth aspirations. You already have a very large fleet, 159 vessels. You have grown significantly through a number of transactions. I'm sure you have aspirations for more. If you
Yeah, no, look, we are already at the size where probably we're getting just about all the economies of scale that you can get in shipping, but we probably still need to be larger from the point of view of the equity investors whom we want to attract into the shareholder base of the company. We are not on any U.S. stock indices because we're not a U.S. company. So we do not get money from index investors. We get money from stock picking investors. And the stock picking universe has basically shrunk in terms of the number of investors, but each investor is bigger. And if you've got a large portfolio, you're not going to make an infinite number of investments. If you make 200 investments, that requires that you research at least 1,000 companies, if your research is well targeted. And you're not going to spend the time and money to research an equity in an industry that, frankly, from the point of view of mainstream equity investments, is a pretty sort of strange little industry with unique aspects that are hard to understand for people who have not got long history with it. And if you've got $100 billion under management, which is not, it's very large, but it's not unusual anymore. Your average investment is $500 million, sort of just by arithmetic. And I think we need to be large enough that somebody can consider investing $500 million. That requires basically a $5 billion market cap. And that basically requires us to be twice as big as we are now. Now, that's not under our control. We have to be very smart or very lucky or both to get there. But at this point, at this moment in time, I think that's how big one has to be to get access to the universe of equity investors that we want to have access to.
Well, Hamish, you are already among the largest market caps and liquidity and so on. I mean, I see your point, of course, but you are already.
Yeah, no, we're one of the largest, but I think we're clearly not large enough. And if you look at the companies that are our size or smaller, they're mostly trading below liquidation value of assets. And if you look at the companies that are twice as big as us and larger, not that there are many, they're trading at above liquidation value of assets. And, that's a crucial line to get over. And so, I think we have to try to do it.
But now that brings me to the next question. Since we talk about investors and shareholders, it brings me to Oaktree. We saw the announcement of the last representative of Oaktree leaving the board of directors. So tell us a little bit about Oaktree. Are they still a major shareholder in Starbulk?
Well, they announced a short time ago that they had sold down to below 5%. And of course, Sherman Lau, who was the last Oaktree director on our board, resigned recently after the announcement that they were below 5%. Oaktree was a very important investor in the company and frankly had made great contributions to the success of the company. But I think in recent years, many investors were afraid of the impact of a sale by Oaktree of their stake, which recently was as large as 25%. In the fall of last year, we bought $380 million worth of stock, basically 20 million shares, at I think an average price of $19 a share, which in retrospect was a very good price. And that basically brought Oaktree down to between 7 and 8%, and made it easy for them to get below 5% without much impact on the share at all. And at this point, we have basically no particularly large shareholder. The public float basically consists of the entire market capitalization.
Great. Thank you. So the next question I wanted to ask you is Fuel EU.
Yes.
This is coming up as of next year. How are you preparing for this? How do you think this might be a game changer for the industry or not?
Yeah, no, this is a very important regulation, and it's going to be a particularly tricky regulation for the shipping industry. The European Union instituted something called the ETS, the emissions trading scheme for ships this year, and basically it requires ships that trade in the EU to purchase emissions allowances, per ton of CO2 emitted, and turn them into the EU. And there are a limited number of these allowances available for purchase. So that is basically encouraging a reduction in CO2 emissions of shipping. The Fuel EU maritime regulations take that a step further and actually require reduced CO2 content fuels to be used by ships trading in the EU. And the difficulty there is that while there are renewable fuels, green methanol, expensive, hard to find, but it exists. Green ammonia doesn't really exist yet, but it is, people know how to make it with renewable hydrogen. And then there's LNG, which can be either renewable if made from biological sources, or fossil if it comes from natural gas wells, but it is probably responsible for less carbon emission than fuel oil. But unfortunately, most ships, including all of our ships, burn fuel oil. And they can't use methanol, and they can't use ammonia, and they can't use LNG, whether renewable or not. The only fuel they can use is biofuel that would count under the Fuel EU Maritime. And the biofuel that is usable in a typical dry bulk ship, and all of our ships, and basically all of everybody's ships, is biodiesel that is made from used cooking oil and animal fat. And if you think about how much gasoline or diesel you buy per week, and how much cooking oil and butter you buy per week, and compare those two, you get the idea that there may not be enough biodiesel to satisfy the demand of the shipping industry, particularly since there is not much difference between the biodiesel that is burned in a ship and what is called a sustainable aviation fuel, which, as people may understand, is in great demand in the aviation industry. So it's going to be a very interesting situation. I suspect that the regulators may go back to the drawing board at some point.
This is kicking in as of next year. It's a
Kicking
very
in
interesting point that you make.
2025. Yeah, yeah.
So let me now conclude with the last question on market outlook. We have upcoming environmental regulations that we just talked about. We have geopolitical uncertainties. How are you positioning Starboard to capitalize on these trends?
Well, so first of all, environmental regulations, we think they are wonderful. The environmental regulations make it very complex to operate a shipping company. The more complex the business environment, the bigger the advantage of being a large company becomes. And we're, as you pointed out, among the largest of the companies in the tramp shipping industry, and I think we're the largest publicly listed dry bulk company. And so we can afford to pay for compliance. We can afford to pay for a little bit of research and development. We can afford to hire people who are experts in these technologies. And the more complex the environmental regulations are to comply with, frankly, the larger the advantage that we have over smaller companies. And the dry bulk industry is dominated by small companies. We're the largest publicly listed dry bulk company. We have about 2% of the world's fleet. It's a shockingly small share for one of the very largest companies. So I think we're well positioned to deal with environmental regulations. Geopolitical uncertainties abound, and as we speak, there are fears that there may be hostilities increasing in the Middle East. Obviously, there's a war going on in Ukraine. These are unfortunate circumstances, but they add to the inefficiencies in the shipping industry and probably make the market stronger rather than weaker. And
also, I think the supply-demand balance remains
the
favorable.
supply-demand balance remains good. The new building order book in dry bulk is just over 9%, which is not as low as it's been, but it's closer to the low than the high. The electrification of the automobile industry is probably good for renewable energy over the long term, but in the short term, it's good for coal. What it's causing is a huge increase in the demand for electricity, which is being met by coal-fired power plants. And so coal is a growing commodity in dry bulk transportation. and it probably will be for quite a few years, maybe. I'm guessing until 2030, 2032. You know, we think the environmental regulations, besides being good for Star relative to smaller companies, are good for the market, as long as you don't own the least fuel efficient ships. You know, to the extent that it becomes very expensive to run an inefficient ship, we should see a 2-tier or 3-tier market develop where the least efficient ships become basically unprofitable to run, and the more efficient ships, you know, have a huge financial advantage. And you know, if you take out the least efficient ships, which you know are generally ships that were ordered in 2007, 2008, and delivered, you know, 2010 through 2012, it's about a third of the fleet. And you know, if you take out a substantial chunk of that, the market will go vertically. It you know, we think the enforcement of the environmental regulations is going to be probably the best thing that could happen to the dry bulk industry.
Hamish,
And
sorry.
yeah, sorry, and I think that's going to be, you know, an effect that will last for almost a decade.
I want to say I had the privilege during Posidonia to moderate a panel on exactly fleet optimization and so on. And Petros Papas, the CEO, was part of that panel, and he was describing the great efforts that you go through to optimize the fleet in terms of upgrades and so on, and the savings that you are achieving through this strategy.
Yeah, I mean, we are paying attention to paint in a way we never have before. Paint is very important to keep hull friction down, and hull friction from fouling is the largest influence on fuel consumption that there is in a ship. You can easily, if your hull is fouled, consume 50% more fuel than if your hull is clean. We're looking at hull cleaning robots. We're looking at ultrasonic anti-fouling devices. We've put on most of our ships, and soon all of our ships, so-called energy-saving devices, which are basically ducts that go near the propeller, just ahead of the propeller, give the water flow a twist in the opposite direction from the propeller, so that, you know, ideally the water comes off the propeller going straight instead of twisting, and that actually saves something like 5% of the fuel. So yes, we're paying a lot of attention to that, and we are using very sophisticated computerized optimization of the routes and speeds of our ships based on the weather that they are going through, and you know, that probably saves about 3% of the fuel.
So if I can summarize what you have been discussing. So on one hand, we have positive supply-demand fundamentals. We have a positive impact of environmental regulations. On the other hand, also we have your own efforts for fleet optimization and cost-saving efficiencies and so on. So combining the two is what we can look at, you know, in terms of positioning Starboard for the future.
Absolutely.
Well, Hamish, I'd like to thank you very much for this very interesting and enlightening discussion. We had the privilege to have with us today Mr. Hamish Norton. He's the president of Starboard Carriers. Hamish, thank you very much for sharing all your insight with us.
Thanks very much, Nicolas.
And we look forward to the next podcast.